Overview: the insurance industry safeguards the assets of its policyholders by transferring risk from an individual or business to an insurance company. Insurance companies act as financial intermediaries in that they invest the premium that they collect for providing the service. Insurance company size is usually measured by net premium written, that is, premium revenues less amounts paid for reinsurance. There are three main insurance sectors: property, casualty, life, health, and health insurance. Property casualty consists mainly of auto, home, and commercial insurance. Life health consists mainly of life insurance and annuity products. Health insurance is offered by private health insurance companies and some LH and PC insurers, as well as by government programs such as Medicare. Regulation: all types of insurance are regulated by the state, with each state having its own set of status and rules. State insurance departments oversee insurer solvency, market conduct, and to a greater or lesser degree review and rule on request for rate increases for coverage. The National Association of Insurance Commissioners develops model rules and regulations for the industry, many of which must be approved by state legislature. The McCarran-Ferns Act, passed by Congress in 1945, refers to continued state regulation of the insurance industry as being in the public interest. Under the 1999 Graham-Leach Financial Services Modernization Act, insurance activities, whether conducted by bank, broker, dealer, or insurers, are regulated by the state. However, there have been and continue to be challenges to state regulation from some segments of the federal government as well as from some financial services firms. Accounting: insurers are required to use statutory accounting principle when filing annual financial reports with state regulators, and the Internal Revenue Service (SAP), which evolved to enhance the industry's financial stability, is more conservative than the generally accepted accounting principle established by the independent financial accounting standard boards. The Securities and Exchange Commission requires publicly owned companies to report their financial results using GAAP rules. Insurers outside the United States use standards that differ from SAP and GAAP. As global market developed, the need for more uniform accounting standards became clear. In 2001, the International Accounting Standard Boards, an independent international accounting standards setting organization, began work on a set of standards called International Financial Reporting Standards that it hopes will be used around the world. Since 2001, over 100 countries have required or permitted the use of IFRS. In 2007, the SEC voted to stop requiring non-US companies that use IFRS to reissue their financial reports for US investors using GAAP. In 2008, the National Association of Insurance Commissioners began to explore ways to move from statutory accounting principle to IFRS. Also in 2010, the FASB and IASB understood a joint project to develop a common and improved framework for financial reporting. Distribution Property, casualty, and life insurance policies were once sold almost exclusively by agent, either by captive agents representing one insurance company or by independent agents representing several companies. Insurance companies selling through captive agents and or by mail, telephone or via the internet are called direct writers. However, the distinctions between direct writers and independent agency companies have been blurring since the 1990s, when insurance began to use multiple channels to reach potential customers. In addition, in the 1980s, banks began to explore the possibility of selling insurance through independent agents, usually buying agencies for that purpose. Other distribution channels include sales through professional organization and through workplace. Auto insurance basics. Auto insurance protects against financial loss in the event of an accident. It is a contract between the policyholder and the insurance company. The policyholder agrees to pay the premium and the insurance company agrees to pay losses as defined in the policy. Auto insurance provides property, liability, and medical coverage. Property coverage pays for damage to or theft of the car. Liability coverage pays for the policyholder's legal responsibility to others for bodily injury or property damage. Medical coverage pays for the cost of treating injuries, rehabilitation, and sometimes lost wages and funeral expenses. Most states require drivers to have auto liability insurance before they can legally drive a car. Liability insurance pays the other driver's medical, car repair, and other costs when the policyholder is at fault in an auto accident. All states have laws that set the minimum amounts of insurance or other financial security drivers have to pay for the harm caused by their negligence behind the wheel if an accident occurs. Most auto policies are for 6 months to a year. A basic auto insurance policy is comprised of 6 different kinds of coverage, each of which is priced separately. Point number 1, bodily injury liability. This coverage applies to injuries that the policyholder and family member listed on the policy cause to someone else. These individuals are also covered when driving other people's cars with permissions as motoristic in serious accidents may be used for large amounts. Drivers can opt to buy more than the state required minimum to protect personal assets such as home and savings. Point number 2, medical payments or personal injuries protection. This coverage pays for the treatment of injuries to the driver and passengers of the policyholder's car at its broadest. PIP can cover medical payments, lost wages, and the cost of replacing services normally performed by someone injured in an auto accident. It may also cover funeral costs. Point number 3, property damage liability. This coverage pays for damage policyholders or someone driving the car with their permission may cause to someone else's property. Usually this means damage to someone else's car, but it also includes damage to lamp posts, telephone poles, fences, buildings, or other structure hit in an accident. Point number 4, collision This coverage pays for damage to the policyholder's car resulting from a collision with another car and object or as a result of flipping over. It also covers damage caused by potholes. Collision coverage is generally sold with a deductible of $250 to $1,000. The higher the deductible, the lower in premium. Even if policyholders are at fault for an accident, collision coverage will reimburse them for the cost of repairing the car minus the deductible. Or if the policyholder is not at fault, the insurance companies may try to recover the amount it paid from the other driver's insurance company, a process known as subrogation. If the company is successful, policyholders will also be reimbursed for the deductible. Comprehensive. This coverage reimburses for loss due to theft or damage caused by something other than a collision with another car or object, such as fire, falling objects, missiles, explosion, earthquakes, windstorms, hail, flood, vandalism, and riots, or contact with animal such as birds or deer. Comprehensive insurance is usually sold with a $100 to $300 deductible, though policyholder may opt for a higher deductible as a way of lowering their premium. Comprehensive insurance may also reimburse the policyholder if a windshield is cracked or shattered. Some companies offer separate glass coverage with or without a deductible. States do not require the purchase of collision or comprehensive coverage, but lenders may insist borrowers carry it until a car loan is paid off. It may also be a requirement of someone dealership if a car is leased. Point number 6: uninsured and underinsured motoristic coverage. Uninsured motoristic coverage will reimburse the policyholder, a member of the family, or a designated driver if one of them is hit by an uninsured or a hit and run driver. Underinsured motoristic coverage comes into play when an at-fault driver has insufficient insurance to pay for the other driver's total loss. This coverage will also protect a policyholder who is hit while a pedestrian.